Good afternoon, everybody. My name's Kim Reynolds, and I'm here this afternoon to give a presentation on a quarterly tax update, basically, things that have happened in the Australian tax arena for over the last 3 months or so. So we'll kick off. Just by way of introduction, the things that I'll be looking at today and speaking about relate to the federal budget that was handed down in May. Some legislation that's been introduced, some as a result of the budget and some other matters that have been ongoing for a little while. Some ATO rulings and determinations that have been of interest, and also things that have come up in our office and from VinLink queries that we've had that I thought I should bring to people's attention. There's also a number of cases that, or a couple of cases that came up with some interesting comments that I thought we should point out. Just highlight some of the ATO action that's going on at the moment with audit activity and review activity, and some of the education processes that are currently in train. Also, some of you might have noticed that last week and the week before, the Tax Office released their 2012 tax returns and schedules. So I thought I'd just touch on some of the points that I've found in reviewing those returns and schedules, things that we need to keep in our minds when doing 2012 returns, but things we need to be aware of when we're asking clients for information this year. 2012 trust resolutions. For those of you that listened to my trust update a couple of weeks ago, I did talk about the resolutions in that session, but I thought we should touch on it again because year end is fast approaching, and we do need to make sure that those resolutions are done. The private health insurance rebate has been a topic of some discussion in recent weeks particularly. We'll talk about some year-end tax issues if we've got some time, and I noticed just in the last few days something came across my desk in relation to the Tax Practitioners Board and their CPE policy that they're putting in place that we all need to keep in mind, and hopefully that these sorts of sessions will assist everybody with. So just firstly touching on the federal budget, it was touted as a budget that needed to be, I guess, hard-hitting. It was going to be, show us how we were going to be brought back into surplus. So we're all expecting a budget that had a lot of measures in it that we might not necessarily like, but from the revenues perspective we could understand where they're coming from. It wasn't necessarily as wide-ranging or as hard-hitting as some expected, so it was again another demonstration of a government that needs to, well, a minority government I guess, that needs to please so many people to get things through, and demonstrated also that they realised that they needed to pick their battles. So we'll go through some of the things that did come through in the budget though. In relation to the area of business, there was an announcement in relation to the ability for companies to carry back losses. So this will start from the 2012-13 income year, where losses can be carried back, and they can be used to offset taxable income and tax paid in the 2011-12 year. In the 2013-14 year, the losses can be carried back 2 years and can be applied against the taxable income and tax paid in 2012 and 2013. Those carryback provisions do have a limit though, where you're limited to carrying back $1 million each year. And it's also important to note something that seems to have been missed by some practitioners, is that these provisions won't be available to clients that trade as sole traders in partnerships or in trusts. So it really is only for companies. So it's not as wide-ranging and as accessible as we might have hoped. Second thing is in relation to the immediate write-off for assets purchased. This has been talked about for quite a little while now, but the nature of budgets is that you can re-announce things that have been spoken about earlier in the year. So from 1 July 2012, small business entities, it's important to remember that those are entities that have got a turnover of less than $2 million, can instantly write off the first $5,000 of a new or used motor vehicle that they purchase, or immediately write off eligible business assets that have been purchased that cost less than $6,500 per asset. Now, just on the small business entities requirement there, one thing I've noticed in recent times is how people are assessing those, whether an entity is a small business entity, tend to be looking at the entity itself. Those tests actually have an aggregated turnover test. So you need to look at entities that are also connected with the entity that you're looking at to see whether the turnover of that group essentially is less than the $2 million that they're talking about. That connected with test is similar to the test that we use for the small business concessions. So it is a little bit of a trap that not to limit your review of what the turnover is to just one entity, but look at the group and the connections that it has. There was talk over the last couple of years about the reduction in the company tax rate. Given the economic times that we're in, including the economic times that the government's in, that reduction in company tax rate has now been scrapped. So it was previously promised that the company rate would go down to 29%. It will now remain at 30%. Another area that's impacting on the business side of things are changes to the living away from home allowance. Now, the government had previously announced changes to the living away from home allowance. Basically, these changes are going to limit access to the tax concessions associated with LUFAs to those taxpayers that maintain a home in Australia for their own use, and where obviously they're required to live away from home for work purposes. These changes are also going to limit access to the concessions for a maximum period of 12 months per employee and per work location. The policy, I guess, behind this is to stop employers from being able to give a tax concession to employees who aren't really maintaining a second home or are maintaining two homes indefinitely. They're not designed to impact on fly-in, fly-out arrangements. So and at this stage, the legislation in relation to this has been released in exposure draft form. Treasury's released an exposure draft with an explanatory memorandum. The bill itself, however, as of last night, hadn't been introduced into Parliament. It still has an effective start date from the 1st of July 2012, so we're working on the fact that these new rules will come into play on the 1st of July 2012, so it's a matter of planning for what we currently understand are going to be the rules. Having said that, notice that when Treasury asked for submissions in the consultation period about this new legislation, they received about 100 submissions about how the proposed rules were supposed to work. So it's possible that there may be some changes to the way that the rules are structured between now and when the legislation is actually introduced. However, it's a bit of crystal ball gazing. We'll need to wait and see the legislation when it is introduced, and you can probably expect that there'll be a bit more scrutiny of living away from home allowances from here on in. So it's a better to keep an eye on it and maybe take a little bit of a conservative approach at the moment till we see what actually falls out at the end. There's also going to be a reduced tax offset for golden handshakes. Now, this measure is going to see higher rates of tax applied to these golden handshakes, where the individual's total annual taxable income, including the ETP, is greater than $180,000. So from the 1st of July, only that part of the golden handshake that takes a person's total annual taxable income to no more than $180,000 will be taxed at the concessional rate. Now, the legislation introducing this has actually been introduced already, so it's definitely going to be around. It's still in the House of Representatives, but it's in legislative form at least. The other matter that I noticed in the budget was the ATO has received a funding boost, which is always interesting to see what funds the ATO has available to it and what those funds are to be used for, where they've been directed. Now, as has been practice in the last few years, that the budget has allowed additional funds available for the ATO and other Project Wickenby type task force agencies to continue the fight against tax evasion and avoidance. There's also an amount that's been allocated to the ATO to improve the management of outstanding tax debts and superannuation guarantee charges. I'm sure we've all noticed in the last 12 months or so an increased focus by the tax office in collecting debts from taxpayers, and the extent to which they'll go to try to get the amount paid. So they've been given additional funds. Again, I think it's over 4 years that these funds have been allocated. That will basically means that the increase that we've seen in attention to this area won't be dying down anytime soon. There's also an amount being provided. I think it's not for another couple of years though, 2014-15 and 15-16, to continue the range of activities that the tax office are undertaking to, I think in their words, was to promote voluntary GST compliance and to provide a level playing field for Australian businesses, so we can continue to see, expect to see a continued focus on GST liabilities and ensuring that payments are made. The last one there is in relation to GST registration. From the 1st of July 2012, there's going to be a limit on the Commissioner of Taxation's ability to backdate registrations for GST purposes. In effect, the registration will only be able to go back a maximum of 4 years. So that's consistent with other time periods that are allowed for in the GST administration. Now, on the superannuation side of things, I'm not going to go into this in a lot of detail because I think Brett covered a number of these off when he did his update last week, I think it was. But there's a deferral of the higher concessional contributions cap for another 2 years to the 1st of July 2014. So that basically means that individuals, all individuals regardless of their age, will only be able to make a concessional contribution of up to $25,000 a year, as permitted under the general concessional contributions cap. There's also a reduction of the higher tax concession for contributions for what's been termed very high income earners. So from 1 July 2012, individuals that have income of more than $300,000 will have the tax concession on their contributions reduced from 30% to 15%. That excludes Medicare levy. And the last one, the low income superannuation contribution. This was a previously announced item that from the 1st of July, workers with an income of up to $37,000 are going to receive a boost of up to $500 in their superannuation savings from the government. Capital gains tax. The capital gains tax 50% discount has now, will be abolished for non-residents. When I say will be, it effectively has been, but the law just hasn't been introduced yet. So the discount will remain, however, for capital gains that accrued prior to budget night, where the non-resident actually chooses to take a market value of the assets as at budget night, which was the 8th of May. Natural disaster relief, there'll be some changes to ensure that taxpayers are eligible for an automatic CGT exemptions, so things like main resident exemptions, so they won't be prevented from choosing the same CGT treatment as other taxpayers because of their particular circumstances because of a natural disaster. Also going to be some changes in the rollover provisions relating to revenue assets and trading stock. So essentially those rollover provisions are going to be expanded to make those easier to use and a bit more taxpayer friendly, I guess. On the flip side of that, the scrip for scrip rules, which allow for taxpayers to exchange scrip in one entity for scrip and another entity as part of a rollover or a restructure. There are integrity provisions within those rules that are going to be amended to make those a little tighter, so that apparently there are still some tax minimisation opportunities sitting in those rules that people have been taking advantage of, and so they're closing those loopholes. In relation to individuals, the Family Tax Benefit Part A, there are some changes in relation to that area. The eligibility age, limiting the age of eligibility for individuals under 18, except in particular circumstances. So if they're still in secondary school in the year that they turn 19, for example. There's a rate increase from 1 July 2013. There'll be an increased maximum payment rate. The portability of payments rules will change also from the 1st of July 2013. So the way that it currently works, I understand, is that the payments above the base rate will be reduced, are reduced after 13 weeks. If you temporarily leave Australia, that will be reduced to 6 weeks. So they're sort of tightening the time frame in which you can get those payments. And they're also streamlining the income reporting process for circumstances where the beneficiary of the payment isn't required to lodge a tax return, and that streamlined income reporting process will also apply to the holders of Commonwealth Seniors Health Cards as well. There's also going to be an extension of the exemption from the flood levy. Now, that will be extended to individuals who suffered flood damage in the 2012 year also. And it includes those that are eligible for the Australian Government Disaster Recovery Payment for a disaster event, those that were directly affected by a natural disaster relief or recovery arrangements and would have met the particular criteria to get one of those payments. The exemption, interestingly too, will also be extended to individuals who are eligible to claim the disaster recovery payment in the 2010-11 year, regardless of whether they actually applied for or received the payment as was required under the current exemptions. So if you have a client that was eligible to claim but never got around to it for whatever reason, never applied, never received a payment, then as long as they were eligible, then they can get an exemption from the flood levy in 2012. Also in relation to individuals was a school kids bonus that replaces the education tax offset. Basically from 1 July 2013, eligible families are going to receive a flat rate, no strings type cash bonus of $410 for each child in primary school and $820 for each child in secondary school. As I said, it'll replace the education tax offset, and as a transitional measure, because this first payment for the school kids bonus won't start until 1 January next year, transitional measure is that the education tax offset will be paid out in full as a lump sum to families in June 2012. So if they haven't started coming already, then they should be here shortly. There'll also be means testing for medical expense tax offset in future. So from 1 July 2012, for those individuals that are above the Medicare levy surcharge threshold, which is $84,000 for singles and $168,000 for families in the 2013 year, the medical expense tax offset threshold will increase to $5,000 and will be indexed annually. And the amount of the offset that the individual will be available to access will only be 10%. So that's reduced from the current 20%. So that's something to keep in mind. There's also going to be a consolidation of dependency tax offsets, a phasing out of mature age worker tax offset. So if you're under 55 at 30 June 2012, then the mature age worker offset tax offset won't be available. There'll be a merging of the senior Australian tax offset and the pensioner offsets. And also there'll be some rate changes for non-resident taxpayers. So not for resident taxpayers, but non-resident taxpayers, there'll be a rate change. So effectively what that will do is merge a number of the lower tax brackets for non-residents, so that in the 2013 and the 2014 income years, the first tax threshold for non-residents will be $0 to $80,000, where they'll be taxed at 32.5%. 80,000 to 180, they'll be taxed at 37%, and over 180,000, it'll be 45%. And for a number of years now, we've heard of the promise that there was going to be a 50% income tax deduction for interest income. That's now been scrapped, and a standard work-related expenses deduction, that's also been scrapped. I think they sounded like a good idea at the time, but actually getting them to work seemed a little bit too difficult. Okay, so as far as legislation is concerned, Tax Law Amendment Bill number 2, and I'm only going to go through a couple of the pieces of legislation. There are others, but these are the ones that I thought would be of most interest. Tax Law Amendment Bill number 2 is currently making its way through Parliament. Basically, this bill introduces the director penalty regime, and it's going, well, extends it, I should say, so that directors are going to be personally liable for the company's unpaid superannuation guarantee amounts. It'll also ensure that directors can't discharge their directors' penalties by placing companies into administration or liquidation when they've got liabilities outstanding in relation to PAYG withholding or superannuation guarantee. And that's particularly where they remain unpaid and unreported for 3 months after the due date. There's also some changes in that bill relating to consolidation, tax cost setting rules and rights to future income rules, which I don't intend to go through today. The director penalty rules, though, are something that we all need to be aware of, because there are clients that through no fault of their own may be falling behind in payments to the tax office. They need to be aware that they can be held liable for these liabilities personally, even though they're in a corporate structure. So it's something that we need to continue to point out to clients to make sure that they're fully informed of these rule changes. Tax Law Amendment Bill number 3 introduces a new final withholding tax in relation to income from those workers that are participating in the seasonal labour mobility program. It also provides some tax exemptions for the clean energy payments, and this is the bill that introduces that ETP tax offset rule that I spoke about in relation to the budget. And it also clarifies that trust beneficiaries that are minors don't receive the low income tax offset for unearned income earned through trust distributions. So that means that the amount that we can distribute to minors without them being taxed in the 2012 year is the old $416, provided, of course, they don't have any other income. For those of you that have clients that deal internationally, there are some changes in relation to the transfer pricing rules. This amendment bill is basically clarifying how our transfer pricing rules and how they should interact with international treaties that we have with other countries. I think from my reading of it, it's, and I used the word clarifying in the slide, it's really just ensuring that our legislation reflects effectively what the ATO has been trying to enforce for a number of years, and so it ensures that our transfer pricing rules are consistent with OECD guidelines as well, consistent with other members of the OECD. Now, the taxation rulings and determinations, the ATO issued a tax determination that clarified that the Commissioner's view in relation to when shortfall interest charges should be are incurred, basically, and when they can be taken into account. Basically, the Commissioner's view is that the shortfall interest charge is incurred in the year that he issues an amended assessment, and it's not required that the amount is actually paid to be deductible. So again, that just goes back to the old concepts of when is something incurred versus is it when you get notification of it versus when it's actually paid. It can be incurred on notification, so that's really just clarifying a situation that's, I think, been the case for a while. Now, there's a GST ruling that's come out also in relation to residential premises and commercial residential premises. I do a fair bit of work in the GST area, and particularly in relation to property and residential premises. What is new residential premises? What are substantial renovations? What are commercial residential premises? All of those questions become very very fact-based. So it's a matter of every time you come across these situations and you've got a GST transaction, trying to determine what type of premises you've got, what type of residential premises you've got, you need to make sure that you classify it correctly for GST purposes, because the GST treatment is significantly different for each type of transaction. So basically what this ruling does is talks about what is residential premises. It's premises that's used predominantly for residential accommodation. It looks at the physical characteristics of the property itself, and it's not relevant what the purchaser or owner, what their intention is in relation to it. So you're actually looking at the physical characteristics. There were some cases a few years ago where the argument was that you needed to determine what the purchaser was going to do with the property to determine whether it was going to be residential or not. That's not the case. You need to look at the physical characteristics of the property itself. Now, just going back a sec to that legislation that was that I spoke about before, Tax Bill number 2 and number 3, both of those bills are still moving through Parliament at the moment, so they haven't moved to the Senate. As I said, as of last night, I hadn't seen that they moved to the Senate, and therefore haven't passed as such. So I imagine there might be a bit of a flurry by 30 June to get some of these through. But at this stage, they're still making their way through Parliament. Having said that, the effective date that's on those should still be borne in mind. If we've got a 1 July start date, then we need to work on that basis, because if they change it, they'll only change it at the last minute anyway. So just getting back to this ruling, the new residential premises, the Commissioner talks about what is considered to be new residential. He does talk a little bit about substantial renovation. He also makes a comment about types of arrangements where, I think that the term that he uses in the ruling is development lease arrangements, where I think some parties were trying to argue that they weren't taxable supplies, and because they were financial type supplies that or input taxed, then the Commissioner's come out and said no, they will be taxable supplies, because essentially what you're providing still is residential premises. There was also some clarification in the ruling about how subdivisions and strata titling of new residential premises are going to be dealt with. And an old favourite is commercial residential premises. As the name suggests, it does require some commercial business-like operations to be taking place. The Commissioner makes the point that they need to be offered to the public, have multiple occupancy, and have a central management type function similar to hotel and motel arrangements. And he also comments on long-term accommodation in commercial residential premises where you're required to make a 50% reduction in the GST amount after 28 days. Now, that particular aspect is sometimes overlooked because it's I wouldn't say buried in those rules, but it's not obvious within those rules, not given a lot of attention in commentary. So it's an area that if you've got commercial residential premises and the client is providing long-term accommodation, you need to be aware of this particular rule it's been around for quite a while, that can reduce the GST amount that's payable. Now, the Taxation Ruling 2012 D1, which Commissioner talks about the meaning of income of a trust estate. I did talk about this a couple of weeks ago in our trust update. For those of you that didn't get to catch up with that session, it's an important ruling that we need to keep in mind for 30 June because it does impact on how we make trust distributions at 30 June and what exactly income is going to be for the purposes of making those distributions. So the draft ruling basically sets out the Commissioner's preliminary view of what the meaning of income of a trust estate is. Its date of effect, according to the Commissioner, is before and after the date of issue, but it won't apply to those taxpayers who relied on the practice statement that was issued in 2009. And that was dealt with how capital gains were distributed, etc. Now, income of a trust estate isn't a defined term, which is probably why it's causing us all so much heartache. The income basically, according to the ruling, has to be able to be measured in the context of distinct years of income. It has to be the product of the trust estate, and it has to be an amount in which a beneficiary can be made presently entitled. That becomes particularly important, that point, when we're talking about income equalisation clauses that are included in deeds. And there's a lot of case law around that basically says that trust income means income that's legally available for distribution to beneficiaries. And because of basically the distributable income must be essentially an accretion to the trust estate, so an increase in what's in the trust estate. I was going to say the value, but I guess it's not technically the value as such. In the context of income equalisation clauses and how the tax office is saying that the income needs to be an accretion to the trust estate, when you have an income equalisation clause, there are circumstances where you can get a distorted sort of effect, I guess. So you can get amounts that receive that wouldn't normally be considered income but are assessable, so things like net capital gains will form part of the trust income. Capital gains are only income because the tax law says that they're income, otherwise they're capital, they're not ordinary income by any stretch. There's certain outgoings that may ordinarily be chargeable against capital that reduce the distributable income of a trust if those amounts are deductible, so things like outgoings for capital acquisitions. You might get amounts that are exempt for income tax purposes, or amounts that aren't deductible for income tax purposes. So all of those tax fictions, I guess, can give rise to some interesting results when you're trying to work out what exactly you can distribute from a trust estate and what the distributable income is. Now, the Commissioner in the ruling has taken the view that where an income equalisation clause is used, an amount is included in the net income of the trust, but it's not represented by a net accretion to the trust estate, then the amount will not normally form part of the distributable income of the trust, and therefore they can't be taken into account in determining what the income of the trust estate is, essentially regardless of whether you've defined income as whatever in the deed. Now, some of the common types of notional income amounts are things like franking credits, where the Commissioner takes the view that a franking credit does not represent an accretion to the trust estate, nor is it an accounting asset because there's no future economic benefit there. Distributions from other trusts, where you might have a circumstance where the the tax versus accounting amount that's been distributed from another trust doesn't represent an increase in the accretion or an accretion to the trust fund of the beneficiary trust. The market value substitution rule contained in the capital gains tax rules can also give rise to a tax fiction. There might be capital proceeds of $100, but the market value substitution rule says it's $150. So that $50 difference is not really an accretion to the trust fund. So therefore, again, another notional amount that shouldn't be taken into account. Division 7A dividends are also in there as well. Loans that are deemed to be dividends are considered to be notional amounts. There's also circumstances of attributable income when we're talking about controlled foreign entities, and also Part 4A amounts as well that could be seen as notional amounts. So all of these things need to be taken into account when you're thinking about your 2012 distributions, when your clients are thinking about those distributions, and making sure that you do actually have some income that's distributable to the beneficiaries. Now, I know that this is a draft ruling and it is the Commissioner's view. However, you know, as we know, it's you need to at least be aware of what the tax office view is and have an understanding of it, so that you can be in a position to either agree or disagree and be able to support, you know, a reasonably arguable position if you want to disagree with the ATO's approach. Now, a couple of cases that I just wanted to discuss. One in relation to the small business concessions. Those of you that listened to the March update will know that I spoke about a couple of small business concession cases back then that talked about the maximum net asset value test and assets that should be included and shouldn't be included. This case here, White versus the Federal Commission of Taxation, the taxpayers were found to have actually satisfied the maximum net asset value test. This was really a consideration of whether the husband and wife together could be connected with the company that they were shareholders in. Individually, the husband and wife were not in control of the company, so weren't connected with the company, I should say. But together, they were connected with the company. However, you could only join the two together if the husband and wife together were small business CGT affiliates, and the court found that they weren't. So because they weren't affiliates, they couldn't be joined together, and as such, they couldn't be connected with the company because individually they didn't have more than 40% each. So as such, they satisfied all of the other basic conditions and the maximum net asset value test as well, so could apply the concession that they chose, which was the 15-year exemption. Now, one of the things I want to mention in relation to this case is there are a number of cases coming through, whether they be AAT cases or federal court decisions in relation to the CGT rules and the small business concessions. And I've noticed that the tax office is making more comments about the maximum net asset value test and ensuring that taxpayers apply the market valuation rules correctly. The ATO on its website has some guidelines, the market valuation for tax purposes guidelines, and it basically says in there that the valuation should be done based on a highest and best use approach. There seems to be a lot of activity in this particular area of late. I'm regularly getting questions from VinLink members and clients as to whether the concessions can be applied, and it's unfortunately the rules themselves are not simple rules, and the fact that there's more scrutiny of valuations, etc., mean that we all need to take a lot more care when applying these rules, and to ensure that the conditions are actually satisfied before putting somebody or saying that somebody is eligible for the concessions. Back of the envelope calculations aren't necessarily going to be acceptable in the case of a review by the tax office. This case related to it was an AAT case. It related to a rental property and whether it was available for rent or not. It was interesting in that the property was, the taxpayer argued that the property was available for rent. However, there wasn't a lot of activity going on in relation to trying to get somebody to tenant the property. So she wasn't vigorous in her efforts to let the property out. She did take out some advertising, but she by no means was really exhaustive in her efforts. The tribunal found that the word of mouth was found to be acceptable because she was in the process of verbally negotiating agreements with people to rent the place. And the taxpayer in that case was allowed certain deductions where they could be substantiated and where they related to the relevant year. However, there were a number of deductions that were disallowed because they either didn't relate to the year that was in question, or there wasn't sufficient substantiation to support the deductions. Now, I mentioned at the outset about ATO Action and also the budget announcement of increased resources, so something for us all to keep in mind when dealing with the tax office and also dealing with our clients, so that they appreciate and understand why the additional questions are being asked and where the tax office is coming from, I guess. Some of the areas that we're seeing some increased audit and review activity is the area of trusts, and I'll go through a couple of things shortly in relation to those. CGT small business concessions, I've talked about the market valuation guidelines and that sort of area. Division 7A, there are some question, an increase in the level of queries as to how Division 7A agreements have been put in place, whether they're sufficient, how the calculations for minimum repayments have been made, etc. There was also a taxpayer alert issued about the non-disclosure of foreign source income by Australian residents. The tax office basically putting people on notice that if you have income from a foreign source, you still have an obligation to disclose it in Australia if you're an Australian tax resident, because you're taxed on your worldwide income. And for those of you that do have clients that invest or operate businesses in other countries, you may well have noticed that there's an increase in disclosure between the various, Australia and other countries. So there's more likelihood of the questions being asked, or at least information being exchanged between the two jurisdictions, and ensuring that tax is paid appropriately in whatever country. Now, I said the 2012 tax returns and schedules have been reduced on the released on the ATO website. As always, I always recommend have a quick look at the changes that have happened between 2011 and 2012, because sometimes there are changes that have been made to the returns and schedules that are easily overlooked while you're trying to get a job out the door. So a bit of nighttime reading for everybody. I noticed, I've got doing quite a lot of work in the area of trusts of late, so I had a look at the trust tax return, and there are some changes to that return where they're requiring details of trust income. So that's per the deed, trust income to be reported. So that's another area where you need to keep in mind that ruling that we just spoke about. Need to disclose the share of the income of the trust estate to which each beneficiary is entitled. The details of the beneficiary's share of net franked distributions, so that enables the tax office to match information relating to streaming rules and the like, and get an understanding of how those rules have been implemented by taxpayers. And also the TFN reporting requirements. That information is on there as it was last year, but the tax office has noticed that that information hasn't necessarily been completed correctly by us all, so it's good to revisit that area. The thin capitalisation and Schedule 25A schedules have both been scrapped and put into one schedule of international transactions. So for those of you that do have dealings with overseas, whether it's sales, purchases, loans, all of those areas, you need to consider whether you need to complete one of those schedules. Trust distribution resolutions. I spoke about this a couple of weeks ago, that as I mentioned, that the Commissioner has had a long-standing administrative practice of allowing till the 31st of I wish it was the 31st of October, 31st of August, for trust distributions to be made by trustees. It was really only effective to those trusts that didn't require distributions to be made by 30 June, or those that didn't have default beneficiaries in there that kicked in at a date earlier than the 31st of August. This 31st of August extension no longer applies, and as I said, in some cases it probably never did. The Commissioner's view is that in order for a beneficiary to be assessed on a share of the taxable income, then that beneficiary needs to be made presently entitled to the trust income by 30 June. Regardless essentially of what your deed says, in order for the beneficiary to be taxed on the income rather than the trustee, the beneficiary has to be presently entitled by 30 June. So trustee resolutions to make distributions to beneficiaries need to be done by 30 June. It doesn't necessarily have to be in the strict resolution format, but there needs to be some documentary evidence of the decision has been made by the trustee as to who's receiving the income for 2012. Some deeds won't require that decision be documented, but that it only needs to be verbal. However, that might cause some problems when trying to support the position that the decision has been made, if you ever get questioned by the ATO. So just keep that in mind. So there's a few things that we need to do by 30 June. We need to work out what the income is of our trust per the deed, and also considering that ruling. Need to look at differences that there might be between what the trust income is and what the net income is for tax purposes. Make sure that we've actually made a beneficiary presently entitled, or beneficiaries presently entitled. Need to work out whether we are going to make somebody specifically entitled to capital gains or frank distributions made, and ensure that those specific entitlements are correctly recorded. And we need to, where we're making distributions by book entry or journal entry, take great care. One reason for doing that is because some deeds don't allow you to do that. Some say that the distribution has to be paid or applied, so it can't be set aside for the beneficiary. And also, as some of you may have heard me say on previous occasions, a journal entry alone is not a transaction, it merely reflects a transaction. So you need to have some document, or recommended to have some document that supports the journal entry that you're actually making, so whether it be your distribution minute or resolution, something that actually shows why that journal's been made. Unfortunately, this is an area that clients don't always understand the legal issues that are associated with it, and they rely on us sometimes quite heavily on making sure that things are right. As a consequence of the increased focus on trusts at the moment, we need to ensure that our clients are made aware of the action that needs to be taken and manage the risk not only for the client but also for our practice as well. Now, as part of the ATO's compliance activities, they're primarily educational in the area of trust distribution resolutions at the moment. They're at the moment writing to about 1,200 trustees, advising them of their need to make resolutions by 30 June. I understand some of those letters went out last week. They will then follow up some of those trustees with further questions after 30 June. I suspect one of those will be, can you provide us with a copy of your resolution? Now, the private health insurance rebate, like I said, there's been a fair bit of discussion about this in recent weeks particularly. The commencement date for this, the change in the rebate, is going to be the 1st of July 2012. Effectively, there's going to be a reduction in the taxpayer entitlement to private health insurance rebate if their income exceeds certain thresholds. The ATO last week confirmed that if you prepay your private health insurance premiums to maximise the rebate available to the taxpayer, then that is permitted. You'll see that link on the bottom of the slide there. On that web page, the tax office goes through the different types of methods of payment that might be made. So whether you pay by cash or an EFT or a bank cheque, you need to, it's when the amount's received, when it's considered to be received by the private health insurer, as to whether it will be counted as a 2012 premium or a 2013 premium. So if you prepay your health insurance by the 30th of June, it'll show up on this year's statement and you'll be entitled to the 30% rebate regardless of what your income level is. Whereas if you're making the payment next year, then you'll be subject to these new rules. Different health funds are taking slightly different approaches to it as to how much time they will allow you to prepay. Some are saying 12 months, some are 18 months. I have heard 2 years, but not officially. So it's yeah, it's a little bit all over the shop. So if you've got clients in that position that they need to, well, they're considering prepaying, it's worth having a chat to their health insurer to find out exactly what they need to do and by when. Because I know some health insurers are requiring that the payment needs to be made by, I think, the 23rd of June, whereas others are saying right up until the 30th of June. Given that 30th of June is a Saturday, I don't know that I'd be leaving it that late. Now here I've just really, the next few slides just looked at some of the year-end tax issues, just more as a reminder to people of things to cover off on before 30 June, just in case you, some of them are the standard items that appear every year when we're thinking about these things, but you know, it's a bit of a refresher for everybody. So things like the income side of things, deferring taxable income, because combined effective tax cuts and the flood levy won't apply next year. So those things may create a tax saving. Deferring income that's received on a cash basis. Might be a chance to prepay certain amounts that you can receive a deduction for. Reviewing bad debts is always an age-old favourite. There may be no incentive to bring forward capital expenditure. We've suggested that in prior years. However, you know, this year maybe not so much because of the increase in the capital allowance incentives that are kicking off on the 1st of July. Also need to look at the non-commercial loss thresholds and make sure that you know, your clients are actually won't be tripped up by those particular thresholds. And always remember those the black hole expenditure when an amount isn't deductible or can't otherwise be dealt with under the Act. Capital gains, making sure that capital gains aren't trapped in a trust with no trust income, so that they can be distributed to individuals. Look at you know, deferring CGT events where possible until after 30 June, so advise you another year as far as delaying the tax payment, and also you might get the 12-month CGT discount. Looking at capital losses before 30 June where appropriate, but also at the same time be aware of the rules in relation to wash sales. So if you go and sell something to generate a capital loss now and then buy the same asset shortly thereafter, at a lower cost, then it could be considered a wash sale, and there'll be CGT implications on that. And also, as I mentioned, the CGT relief available in relation to natural disaster. Small business concessions. Always consider the impact of dividend access shares and the effect on the small business participation percentage for significant individuals. Some of you will be wondering what that's about, and hopefully I never have to deal with it. But if you've got clients that have dividend access shares, be very careful with what sort of entities that they're issued in relation to and how they're used, because they can have potentially significant impacts on value shifting purposes, but also for these small business concessions. The active asset test, making sure you've got CGT concession stakeholders. So these are all things that you'll need to take into account if you're making distributions and need to access distributions from a trust and need to access these small business concessions. Also looking at the small business rollover and looking at your market value, your maximum net asset value test, $6 million test, and those market values of assets, because you might actually satisfy those conditions where previously you didn't. Division 7A, the age-old favourite of making sure your minimum yearly repayments have been made. Consider your distributable surplus. Looking at your UPEs, whether you need to put loan agreements in place now for those unpaid entitlements, because you've tripped up the 12-month arbitrary time frame that the tax office have referred to in their ruling about UPEs and Division 7A. So reviewing all of those to make sure that you do have loans correctly documented. Also having a look at your deeds to make sure that if you make an unpaid entitlement to like a distribution to a company or any beneficiary, whether it remains as an unpaid entitlement held on separate subtrust for that beneficiary, or whether it automatically becomes a loan. There are some deeds out there by providers that automatically convert the UPE to a loan, so you don't have that extra 12-month window to wait before you put it on Division 7A terms. So pay attention to that. And lastly, now that everyone's head's exploded with all of the information that we've gone through in the past hour, with all of our memberships and whether you're a member of the Institute of Chartered Accountants or the CPAs or the NIA, all of those organisations require that we maintain our CPE hours, because as you can see, things do change in this area, and we somehow need to keep on top of it all. The Tax Practitioners Board has also come on board requiring a continuing professional education policy be abided by all its registrants. So all agents need to maintain a record of their CPE from the 1st of July 2012. Now the CPE activities, similar to other in the Institute, etc., those CPE activities can include attending seminars and conferences, reading technical publications, or presenting sessions. Over a 3-year registration period, the Tax Practitioners Board says that agents need to undertake a minimum of 90 hours of CPE, while BAS agents need to undertake a minimum of 45 hours. And importantly, from 1 July 2013, the board will start asking agents how they comply with that CPE policy. So if you're not keeping a record of your CPE, now's probably a good time to start, because it used to be that maybe only one organisation could ask you for your CPE information, but now there's, depending on how many bodies you're a member of, any one of them could ask you for that information, so it's a good idea to keep it up to date, because the chances of being called on to provide the information are increasing. Okay, well that's everything I've I've got for today. I hope that everybody found that of interest. If you've got any questions, feel free to contact me on my email or my phone number that are both there on that slide. Otherwise, I will catch up with everybody in the next quarter. Thanks for listening. Okay, bye-bye.